In today's video, we're looking at Adobe, a very interesting company. I'll show you the fundamentals of this business and find out if it's a good investment from a value perspective. I'm going to use my own assumptions and analyst assumptions to make a price target and a fair value for Adobe. A little bit about them. Well, they own all of these. I actually use quite a bit of them. I use Lightroom, Photoshop, and Premiere Pro. Basically, if you do anything like creative artwork or anything like that, you basically use Adobe because they have Photoshop, they have Illustrator, they have Premiere Pro, they have all these. They have like 50 products, right? And you get like a subscription, and then it's like $30 a month, and then you get all of these things, and you also get their cloud, Creative Cloud, where you basically have access to your data from all of your devices. So they have a really compelling offer. They have a lot of moat, strong competitive advantage here. There are basically no competitors threatening Adobe in any way. Right now I can't come up with any names that would be like a competitor. So they really dominate this market. What I want to do first of all here is look at some metrics here on Everything Money, the Everything Money software. So first of all, we have a market cap of $216 billion. So it is a large cap stock, just in the edge there, above 200 billion. They have a 44.8 times price to earnings ratio, and that is quite high, especially for a large cap stock. You have to remember it gets harder to grow a company the bigger it gets, and the price to earnings ratio basically tells you the premium that you are willing to pay now in exchange for something more in the future. So the higher the price to earnings ratio, generally they are forecasted some more growth in the future, and we will see it's a growth stock, not over its growth days. Definitely this company here. So we'll see about this one in a bit. They have incredibly high gross margin here because it's a software business, 88% to the bottom line, and a profit margin here of 30%. They have a price to sales of 13.4, and they do an average $4.5 billion in free cash flow over the past 5 years. Last year it was a bit higher, that was $6.8 billion. So one thing that we have to look at here with Adobe is definitely the returns that they generate, both on their equity, their assets, and their invested capital. So you can see here the 5-year return on invested capital is really high for Adobe here. It is 23, and we normally want that to be greater than 9. This is the metric that investors use to determine how good a company is to generate returns on the money invested in the business. So when you invest $100 into Adobe, they'll basically generate $23 in return in average over the past 5 years. Last year it was even higher, it was 34, almost 35. So that is a very high return that they generate. They're really good at using their investors' capital to generate returns, which is a very important thing. Their return on equity is also incredibly high. We want to see here in the income statement that they're actually growing. And you can see if we go back to back 5 years, you can see they did $7.3 billion and in revenue, and last year they did 15.8 billion. So they are growing massively, over a double in revenue there over the past 5 years. We want to see their shares outstanding either decreasing or staying the same. The reason for this is if they are issuing more shares, which is the bad thing, that is what we don't want. That dilutes us as shareholders of the company, makes our share worth less. But if they don't touch the shares outstanding, it's basically neutral, and if they buy back shares, we get a larger stake of the business as they buy back more shares. And you can see if we go back 5 years, they had 493 million shares, and last year they had 477 million shares. So they have bought back a bit of their shares, not a lot of their shares, but a bit. We also want to look at their net income here. Go back 5 years, they did 1.7 billion, and last year they did 4.8 billion. So they are massively growing their net income also. Now we go into the balance sheet, and here we can see the financial position of the company, the financial health of Adobe. As you can see here, they have 5.8 billion in cash that they have on hand. That is cash and short-term cash equivalents that they can just use instantly. So we want to see they have 18.5 billion in long-term assets, and that covers their long-term liabilities, and that also covers their total liabilities. They can actually pay off their total long-term liabilities with their cash on hand, which is a great thing to see. Basically, with the cash that they have on hand, they could pay off their entire long-term liabilities, but they could not pay off their total liabilities. But that is not something that we really normally see in a company. So they have a good financial position, this company. We want to see their free cash flow increasing over the past 5 years. We can see it went from $2.7 billion to $6.88 billion. And the capital expenditures, which is right here, has pretty much stayed the same. They haven't really increased their capital expenditures. That means they're not investing massively into like new infrastructure, new business, and also that's because it's a software business, right? They don't really have that many expenses. Like last video we looked at Intel, and Intel has just used $20 billion for a mega factory, right? So that is the kind of expenses that Adobe gets rid of because it's a software business. When we look at the 8 pillars all taken out for us here, you can see that we have 2 X's, and these are the value indicators. But yeah, let me just go over these. So we have the 5-year return on invested capital, which is 23, and that is a lot greater than 9, so that is absolutely a check mark there. We have revenue growth over the past 5 years. We have net income growth, and these are huge. These are like doubling, so it's not a little tiny bit of growth. It's actually a lot of growth. They have decreased the amount of outstanding shares with 4% over the past 5 years. They are in a good financial position because their long-term liabilities divided by their 5-year free cash flow is 1.2, and we want that less than 5. So they have a lot of cash flow output, and if you compare that to their level of debt, that is very, very sustainable. Their cash flow has been growing massively over the past 5 years. The only 2 X's here are the value indicators. This doesn't necessarily mean that we are going to skip the stock because, you know, for example, I just bought Facebook, right? And Facebook also doesn't check these 2 marks here, even though it is like fallen with like 50% or something. That is why we use the stock analyzer tool, because it allows us to put our assumptions about the future, low, mid, and high assumptions about the future, and then we get, when you hit the analyze button, we get a price target. So here we put in 10 years of analysis, and then we put in our revenue growth assumptions. So you can see here for the historical, you know, over the past 10 years, they have done an average year-over-year revenue growth of 15.6%. Over the past 5 years, that has been 20%. And over the past year, that has been 18%. As the company grows, we have to think about this is 10 years into the future. So whatever we put in here is the average that they're going to do year over year over the next 10 years. So we put in 10%, they're going to do 10% revenue growth every year for the next 10 years, right? So we also have to remember that we want to go conservative with these estimates because it's our job as investors to find great deals, not like half decent deals. The thing that is kind of triggered right now, because we have so much inflation, we're probably going to have that over the next like 5 years, right? That is of course going to take up, they can increase prices, and that is going to also be seen in their revenue growth here, revenue growth. So these are my start assumptions. And for the price to earnings ratio, guys, when the company grows, we can't expect as high of a price to earnings ratio. So here's the only reason that I put in these high numbers. Normally I would go for 14, 16, and 18 for the price to earnings ratio in 10 years. But for now, because this company has such a strong moat, and there are no competitors really that are like a threat. If you look at companies like PayPal and also like Facebook, you know, a lot of competitors are actually coming up. They're constantly pressuring this company and taking away market share. For Adobe, they pretty much dominate the whole entire market. So that's why I'm going to go 16, 18, and 20 for this one. That is still high. So yeah, maybe a little bit too high. So guys, here for the desired annual return, I put in 12.5%. And the reason I do that, I always do that, because I want a nice margin of safety. Plus, you could just go out, buy an ETF and get 9 or 10% every year investing in like the S&P 500. And you actually want it to be worth your while to invest in the stock. So that's why I take like the extra 2% here, 2.5%. You want it to be worth your while and you take on more risk and all these things. So that is a nice margin of safety to have. Basically what this means is, now I hit the analyze button, go down, red. So if you believe in the mid assumptions, they are going to do 13% revenue, they're going to have this profit margin, free cash flow margin, they have in 10 years an 18 price to earnings ratio. You should be paying $250 for Adobe if you want a 12.5% year-over-year return. So a little bit better than the S&P 500. So this is the chart of Adobe, and you can see they have taken a hit here, 30% hit. So over here they were completely overvalued. I'm sorry to say it, guys, they were really insanely up there, right? But now they've fallen 30%, and I'm actually looking for them to go down another like 40% before I'm interested in buying them. But they have done that before, right? They have had crashes here, and you just have to remember, guys, these high PE companies, they're the ones that get hit the hardest when we see a recession, right? When we see like people starting to move out of the stock market. People don't want to be in these investments that they don't know what is going to happen in the future. That is my price target. It's around $300. That is my price target. When it gets there, I'm most likely going to buy this company because it's just a great company. They are good at everything. They're just really, I like their products a whole lot, and they have good management. They're good at operating the company. The only thing I don't like is the fact that people just overpay for them right now at the moment. But let's look at analysts, because analysts, they sometimes have some different opinions than me. So you can see here, this is the EPS estimates for the current year that we're in, 2022, and for the next year, 2023. And we have 27 analysts here, so these estimates should be pretty reliable. And you can also see the low estimate and the high estimate. We're of course going to take the average, but they're pretty close, right? So it's not going to be a huge difference there. The average, they're pretty like, they agree pretty much on what they're going to do. So what I want to do, guys, is I want to, let's say that Adobe stays at this price for the rest of the year, and they do this EPS that analysts thinks, right? So let's say they stay at this price that they're currently at, and then they do $13.66 in EPS. That is going to bring their price to earnings from 46 down to 33. That is a much more attractive price to earnings ratio for me as a value investor. So if they stay, and if they even fall a bit, like I suspect they're going to, because they are overvalued at the moment for my assumptions, this is looking like, I mean, if they do these estimates, they could already be a buy in maybe the end of 2022. Let's say they keep that price to earnings ratio of around 33, 35, which I'm much more comfortable buying at. And let's say they do next year's results of $16.1 per share. Multiply that by their price to earnings that I could see them trading at, and we have a price of $560. Safe to say that they're overvalued at the moment, but here in the next year or 2 years, like, there could be an opportunity to pick up some nice Adobe shares at a relatively cheap price, and then just run with them for a couple of years, sell them off, and yeah, that is what I'm going to do in regards to Adobe. And I hope you enjoyed this video. If you did, make sure to like and subscribe, and I hope to see you in my next video. Have a great rest of your day. Peace out.